Shukru Gumush sells household utensils from his shop here in Istanbul. He says the depreciation of the Turkish lira is forcing him to raise prices for his products.
Most of our raw materials come from abroad and we have to pay for them in foreign currency. That's why currency movements have a big impact on our business.
Many other businesses in the country also rely on imports for energy and raw materials, and a weaker domestic currency is driving up costs for all of them. In August, inflation rose from 15.9% to 17.9%. That's putting pressure on the central bank to raise interest rates when it meets next week.
The central bank will take the necessary actions to support price stability. Monetary stance will be adjusted at the September Monetary Policy Committee meeting in view of the latest developments.
The finance minister says the government is in a full-fledged fight against inflation and that it will take more steps to support the local currency. Relations between Ankara and Washington, D.C. have deteriorated in recent weeks, taking a hit on the Turkish lira. Now, President Recep Tayyip Erdogan wants to cut the country's dependence on the US dollar, and the government's negotiating with Russia and other countries to carry out trade in each other's currencies instead.
Now, we are talking about trading in the ruble and Turkish lira with Russia rather than US dollars. In the same way as Iran and China, we are starting a period of using local currency. These attacks do not have any economic base nor bear any relation to Turkey's economic welfare and are being conducted through currency to make Turkey surrender economically.
But setting up alternative financial institutions will take time. Turkey's central bank needs to move much sooner. And traders like Gumush hope that it will rein in the spiraling cost of doing business. Mobin Nasir, TRT World.
So, as we see, it is quite a delicate economic balancing act that Turkey's having to perform, and to help us navigate through the various issues, I'm joined now by Taha Arvas. He's a financial columnist at Turkey's Daily Sabah newspaper. Taha, great to see you, as always. Let's start with the inflation data, 17.9% for August. That was quite a bit higher than a lot of analysts had expected, even given the pass-through effect of the currency's fall over the last couple of months. This is a little worse than a lot of people had expected, right?
I mean, I've heard that it's worse than people have expected, but it's also in some instances, frankly, I was expecting worse, to be honest with you. I think there are many effects that have not yet been felt. Inflation, many of the pass-through effects, or many investors are believing that the next month we'll actually see more inflation come through as oil prices increase. So yes, it was the numbers weren't great, but I mean, as soon as the numbers were released, the Turkish lira strengthened against the dollar because some investors apparently had thought it would have been worse. So that's where we are. You know, we'll see what happens next month, I guess.
It isn't just Turkey, of course. Now, other emerging markets are also feeling the sting as risk-averse fund managers move money to safer havens. Currencies are weakening as capital outflows expose underlying cracks hidden in the flood of cheap money from overseas. Trade tensions between the US and China are adding to the jitters. The Argentine peso continued its slide despite efforts to bolster government finances. President Mauricio Macri has announced the elimination of some ministries and a tax on exports. The Indonesian rupiah has hit its weakest level since the height of the Asian financial crisis in the late 90s. Around 40% of its government debt is denominated in foreign currencies. That makes it vulnerable to currency fluctuations. Strong economic growth failed to shield the Indian rupee, which fell to another record low due to higher oil prices. The economy grew 8.2% in the second quarter, but in August, a manufacturing slowdown could point to a loss of momentum. Craig Earlham is a senior market analyst at the trading firm Oanda in London. He says many investors in emerging markets are heading for the exit.
We are seeing a slight contagion effect. There are other markets where we are seeing slight drop-offs, and that's not entirely unusual. In times of emerging market stress, whether that's being driven by overall trade or anything else really, people do look at other areas of potential weakness in emerging markets because, as we've seen before, when you do start to see that contagion effect, then the impacts can be quite significant, and people don't want to be the last out of the room in that sense. And what we've seen is other emerging markets like the Indian rupee, for example, we've seen sell off, even though the economy there is doing quite well, but because it does have a current account deficit and that's expected to grow due to rising oil prices with it being a big importer, people do look at that as a potential area for weakness further down the road and don't want to, like I say, be the last one to get out.
And joining us from Paris is TRT World's editor-at-large, Craig Copetas. Hello there, Craig. Good to see you. Let's talk about Argentina first. It's already gone to the IMF. It's always a painful decision for any country when it has to do that. And normally the presence of the IMF would be a signal to investors to back off from speculating on the currency. But not this time. Is the IMF losing its clout?
Well, that ended long ago. The answer to the question, I'm getting some feedback here, and I can't hear you. Sorry.
Craig, I think we seem to be having some audio issues. Craig, can you hear me now? Is that...
Yeah, I can hear,
okay.
I can hear you now. Feedback, but who cares?
Let's talk about Argentina.
We will plow through the chaos like the currency markets.
Right.
Look, this all goes back to 1944. Bretton Woods.
Okay. We're going to have to go back to Craig in a second, but Taha Arvas is back with us. Taha, we were talking about Turkey. Let's talk about the central bank meeting on September the 13th. They say that they're going to take all necessary measures to support price stability. Given the recent context of the inflation data and the currency drop, what, in your opinion, does that mean?
I think it's a good question because it's kind of a toss-up. We saw what happened in Argentina, increasing the interest rate, IMF coming in. That did nothing for the currency. That's the problem. So if the Turkish central bank, the same thing, jumps in with huge increases in interest rates and echoes what they've done, what Argentina has done, then Turkey may share the same fate. So it's a cautionary tale what Argentina has done. So it's going to be interesting to see what they do. I mean, like you said, it all but guarantees an interest rate rise, but I would be hesitant to say it's a lot because of what happened in Argentina.
Right. Now, I'm glad you brought Argentina up because we were going to talk about Argentina with Craig. From the point of view of emerging markets like Turkey's, looking to circumvent the US dollar in terms of trading for goods and services, in practical terms, how would such a system work?
Well, I think what you would need to do is have countries agree on methods to exchange goods. So Turkey's major import and export partners would have to be a part of this. So for Turkey, that means, frankly, it means the euro to a large extent, only because the euro is the largest. The European Union and the EU, Eurozone rather, is the largest market for Turkish exports. But we're talking about, that's also connected to the dollar. So how could Turkey export and import things based solely on the Turkish lira? That's going to be a challenge, only because the commodities, energies, these are all denominated in US dollars. So how could you do that without, you would need some long-term agreement with these countries. I think we talked about China in the intro to the show. So, if you had a very strong partner like China or Russia, or the EU, then that would be feasible. But Turkey by itself, it would be difficult. But they would need to have this these partners with Turkey for that to be feasible.
Right, and Craig Copetas is back with us. Good to see you again.
Yeah.
We've got you both. That's great. Craig, we were just talking with Taha about the possibility of Turkey using the Russian ruble, the Chinese yuan, to trade for goods. Is this an opportunity for places like Europe and China to muscle in on the global dominance of the US dollar?
Alternatives to the dollar as a global currency are the stuff of an edgy comedy routine, and that's not an ideological response. Historically, it's impossible to really do that, and that's because of Bretton Woods in 1944 after World War II, where a few dozen countries got together and they created the post-World War II economic order. The IMF was created to regulate exchange rates, and the World Bank was created to rebuild countries that were shattered by war. But today the war is different. It's a financial war. In the old days, if you had a beef with a country not paying, you sent a gunboat upriver to take the money. Bretton Woods ended that. And what grew out of that was something called conditionality, a very important term. That meant the IMF would go in and say, we'll take care of you, but you have to follow these conditions. No reforms, no money. The weapon, instead of gunboat diplomacy, was something called the Structural Adjustment Program. It's kind of a heavyweight term, but it basically meant you're going to follow our rules or you're not going to get relief.
For now, Craig Copetas and Taha Arvas, thank you very much indeed.